As a reminder, one of the first things that you have to determine when it comes to filing your taxes is all of your total income sources. So we're going to find all of our income. Then we're going to subtract certain things called above the line deductions. That's going to eventually give us a number called adjusted gross income, or modified adjusted gross income is another term that you'll hear throughout this podcast. And after we find that adjusted gross income, we're then going to make the decision of whether we're going to take the standard deduction or if we're going to itemize our own deductions. The standard deduction is also available to any taxpayer, regardless of how they file their taxes. If you're looking on screen, you can see that in 2024, the standard deduction for a single person is $14,600. For someone married filing jointly, $29,200. Married filing separately, $14,600. If you file head of household, it's $21,900. So you can use the standard deduction to take that adjusted gross income and lower the income on which you pay taxes even further. Regardless of what's going on elsewhere in your taxes, you have this tool available to decrease your taxable income accordingly. Or if you have your own itemized deductions, which are called below the line deductions, you can itemize them on your tax return and you can take an even bigger deduction. To give you a quick example, let's say that we have a single person who makes $100,000 and they have above the line deductions of $10,000. They have lowered their taxable income to that point to $90,000. They can also then use the standard deduction to lower it an additional $14,600. So that takes it from $90,000 down to $75,400. Or they could total up their own deductions and maybe they have $20,000 of itemized deductions, which is a larger number. They could then choose to use that number instead. And even though they started and made $100,000 worth of income based on their above the line deductions and their itemized / below the line deductions, they only actually pay income tax. They actually only have $70,000 of taxable income that's applied to the tax brackets. After we figure out how much they owe in taxes, we can then use a tool called tax credits to lower that tax dollar for dollar. So whereas a tax deduction lowers the amount of income on which you pay taxes, a tax credit actually reduces the taxes that you owe dollar for dollar.